The 30-year Treasury yield just closed at a level we haven't seen since 2007. That's not just a statistic. It's the bond market screaming that something is fundamentally off. For years, the Federal Reserve has been the undisputed heavyweight champion, dictating the tempo for interest rates across the board. But now, the longest-dated bonds are openly defying that control, pushing yields higher and challenging the very core of the Fed's tightening cycle. By the end of this, you'll understand what's driving this unprecedented move, why it matters for your money, and what signals to watch as this plays out. Let's be clear. The 30-year yield hitting a 2007 high isn't just a random number. It's a decisive breach of a critical resistance level that has held for over a decade and a half. This isn't a small adjustment. It's the market telling us that the brakes the Fed thought it had on long-term rates simply aren't working as intended. The bond market, specifically at the long end of the curve, is effectively pushing back hard against the Fed's narrative of maintaining its restrictive stance without significant long-term consequences. This is a big deal because the conventional wisdom that the Fed controls the entire yield curve is now being tested. Why does this matter so much? Because the Federal Reserve's primary tool to fight inflation is to raise short-term interest rates. The idea is that these short-term rates influence longer-term rates, slowing down the economy. But when the 30-year yield, which reflects long-term borrowing costs, surges like this, it signals a deeper skepticism from the market. It suggests investors are pricing in a future where either inflation persists longer than the Fed expects, or the Fed itself won't be able to maintain its restrictive stance without significant future costs. This breakout implies the market sees a different endgame than the Fed's official narrative, potentially a future with higher inflation or a weaker dollar. So, what's actually driving this? It's a combination of factors. First, the market is pricing in a higher perceived inflation risk over the long term, demanding more yield to compensate. Second, there's growing concern about future bond supply. The U.S. government is issuing more debt, and the market needs to absorb that. When supply goes up and demand doesn't keep pace, prices fall and yields rise. Third, the Fed's restrictive stance is also playing a role. By keeping short-term rates high, the Fed is trying to slow things down, but the market is interpreting this as a potential for future policy errors or a longer period of economic uncertainty, which also pushes long-term yields up to compensate for that risk. This isn't just a bond market story, it's rippling across other assets. We're seeing what some are calling debasement trades igniting. These are investments designed to hedge against a weakening dollar or persistent inflation. Gold, for example, has remained remarkably firm even as yields climb, acting as a traditional store of value. In the crypto world, some altcoins are posting strong gains. Assets like CC, AAVE, and CRO, for instance, are seeing increased interest, potentially as investors seek alternative stores of value or inflation hedges outside of traditional fixed income. This divergence highlights a flight to perceived safety or assets uncorrelated with traditional markets, a clear signal of market anxiety. From here, there are a few concrete levers to watch. First, keep an eye on any official or unofficial signals about the Treasury General Account, or TGA. If the TGA is used for bond buybacks, that could temporarily ease supply pressure. But it would also be a strong confirmation that the market's distress is forcing the government's hand. Second, watch the 10-year Treasury yield. If the 10-year follows the 30-year decisively higher, my thesis on sustained long-end pressure will strengthen significantly. If it holds, it suggests the market is still debating how widespread this pressure will be. Finally, the Fed's next moves, and crucially, how the market reacts to them, will be critical. Any shift in their language or policy could either calm or further ignite this bond market rebellion. The bond market is sending a clear message. The Fed's control is not absolute, and investors are demanding more to hold long-term debt. This isn't just about rates, it's about the fundamental trust in the system and the perceived path of inflation and growth. My read is that the market is mispricing the Fed's ability to maintain its restrictive stance without significant long-term consequences. This is a dynamic situation, and it demands constant attention. For the full written breakdown and my real-time updates on these signals, head over to korra.finance.